for founders, executives, and investors who may be hearing about Be Tomorrow Ventures for the first time, how do you explain what BTV actually is? And how would you say it's different from traditional VC fund?
So I'm going to use this up to give a mini crash course on CVCs. So that's another word for corporate venture capital. So B Tomorrow is the corporate venturing arm of BAT, a British American Tobacco. This idea of CVCs has been around for a long, long time, but I think it's really actually only in the past 2 or 3 years where we've seen a large uptick in both the number of funds and also the activity of those funds. Essentially, it's usually structured as an investment fund or a team that's set up within the larger corporate to help the corporate address critical business model disruptions. So like a CEO might charter this new division to build innovation as a core competency. He'll help set vision and strategy to identify and develop innovative new businesses and solutions. There's a lot of different structures out there that big corporates have utilized to navigate open innovation. So it could be through a CVC. So it's like Be Tomorrow Ventures, where you are a venturing fund and you make minority investments, and you might partner with a business development team or portfolio development team internally to support minority investing activities. There's also something called venture clienting. It's like a startup commercial partnering, but without the equity investment bit. And there's also venture building, which is literally internal incubation and co-creation with external parties who are starting startups. And then there's also the acceleration model, which a lot of people might be familiar with, cohort-based mentoring and resources from the corporate. To your question on how it's different. So if you think about the traditional VC ecosystem, so you usually have general partners, GPs who go out to LPs, limited partners, and raise funds to back a certain investment thesis. In this model, the GPs will have jurisdiction to make investment decisions in their ICs on what companies to back, how to structure investments, and so on. But what's different with CVCs is you're generally more bound by the strategic guidance of the corporate. Some CVC units have more freedom to make what the investment team deems as strategic bets or even venture bets. And others need specific sign-off from the corporate or the sponsor from the relevant business unit. I say BTV is a little bit blend of both because we, one, need sign-off from our sponsor on a number of investments, but we also have, the jurisdiction to play and make a few venture bets that we think would be strategic